Okay, in this chapter, what we're going to be doing is talking about selecting and financing housing. We've talked about how we get money, how do we save it, how do we spend it, looking at credit, and now what we're going to be doing is looking at housing and some of the things that go along with it. You can see in the slides and um, in the book what the learning objectives are. We're going to be looking at both renting and purchasing housing. And one of the things that's really important is to think about what kind of lifestyle that you want to have. How do you want to spend your money? Do you want to rent? Do you want to buy? What is it that's really important to you? And one of the things to think about is spending no more than about 25 to 30% of your take home on housing. All right. It's going to be deciding, whether you rent or buy and where you live and things like that based on lifestyles and what it is that you can afford at this point in time. You can see some of the advantages and disadvantages of both renting and purchasing. With advantages, as far as renting, man, it's real easy to move. You sign a lease for like 6 months, typically a year. And once you're done with that year, you want to live someplace else, you can. It's real easy to move. However, you don't have any tax benefits that you might have with housing. Also, you have limitations as far as what it is you can do in remodeling, what kind of carpeting you can have. And if you want to knock out a wall or something like that, you can't do that when you're renting. When you start thinking about renting, you have to think about where it is that you want to go, okay? And think about the advantages and disadvantages that go with it. When you think about some of the activities, you start off with your search. And again, this is in the book. You can check this out. Before signing the lease, verifying various things, make sure you understand what that lease is really all about. What's going to happen while you're living there? You better keep it in good condition because you're going to have to pay for any kind of damage that you might have had. And then at the end of the lease, clean the sucker up, all right? And let the landlord know that you would like to get that security deposit back and hopefully that you can. When you start thinking about where to rent and thinking about an apartment, always think about some of the locations. I mean, like things like shopping. If you're going to go, are you close to a grocery store? Are you close to the things that you need to be able to purchase? What's the place look like? Okay, what kind of condition is it in? What kind of security is there? And so these are all things to think about when you're looking at renting an apartment someplace. When you rent it, you will be signing a lease. The lease basically protects both you and the owner of the place, where it's saying, okay, this is how long it's going to be. You have access to it. These are things that you can and cannot do. Here's a security deposit that's necessary. It lays all of that out. Make sure you understand all the aspects of the lease before you sign it, because you will be stuck with that for a year. It is a binding contract. You typically provide a security deposit. They typically ask for about 1 month's rent up front. And then what you do is you pay your rent at the beginning of the month. All right. Utilities typically aren't covered in rent payments. There may be some apartments and things where it is covered. Most of them are not. One of the things to think about is having renter's insurance. What happens is you have stuff that's in there. If anything happens, a flood or a fire or something like that, your renter's insurance will cover your internal stuff. You don't have to worry about the structure itself. That is dependent on the owner. You just have to think about your internal stuff. And so it's a good idea to have renter's insurance. When you're thinking about buying a house, the all-American dream, these are some things to be thinking about. Okay, what kind of needs do you have? How big of a house do you really need? Where is it? Find and evaluate selection and a location where you want to live. As property managers and real estate agents say, the key thing is location, location, and location. Think about the price. In other words, what is it that you can afford? Get the financing and then close the transaction. Okay, so that's the process that goes with it. One of the things to think about is the financial benefits that go with it, because you can reduce your taxes by the property taxes and the mortgage interest that you pay. Plus, with purchasing a house, you typically have an increase in the value of the home. So you're building up equity as far as the home is concerned and for your financial situation. You can think about different ways and different types of housing. Single family, which is a lot of people do. You also have like duplexes and townhomes that people live in, and which can be very beneficial at times. You could also have a condominium. Now, condos are not buildings per se. It's a form of home ownership where everybody's kind of kicking in, and you own a portion of the building. Co-ops, okay? Basically, a co-op, you are purchasing stock in a company, a nonprofit company, and that allows you to live in a particular unit for as long as you need to, for as long as you own the stock. Then you have manufactured homes, things like double wides. For example, my in-laws live down in Florida. They retired. They live down in Florida. They live in a retirement area, and all of the homes there are double wides, and they go from anywhere from it's like 850 or 900 square feet, all the way up to about 2,000 square feet as far as the size of the homes that they have. What they do is they purchase the home and they lease the lot. Now, if you decide to build, well, you better do your research as far as a builder to work with. There are some good ones out there, and there are some who are a little questionable as far as some of the things that they do. So you need to make sure that you have done your research on the builder themselves and what it is that you want, where you want to have it, how much is it going to cost, things like that. My wife and I built our home 30 years ago, and it was a wonderful, wonderful experience. You have to think about where it is, what kind of house you want to have. Is it something that's going to satisfy your needs? When you're thinking about buying, you have to think about both price and quality. Okay, what is it that you can afford, and what quality do you want to get? For example, you could get kind of a handyman special. In other words, one of the things that happens is you buy a house that needs a lot of fix-up, you can get in much cheaper, but you better have the handyman skills that go along with it. So when you're thinking about the home buying process, the second step is finding and evaluating a home. Now, if you've gotten pre-qualified, particularly, getting pre-qualified saves a lot of time and hassle, because it's basically saying, okay, how much home can you afford? And it gives you some direction as far as where it is you want to look and what it is you want to look for. So the first thing you do after you get some of that down is select your location. Think about the school system if you have kids. We live in an area that has some fantastic schools. We deliberately went to that area for those schools. And you want to make sure that you can work with a real estate agent, because what they have access to a heck of a lot more homes and can give you some ideas as far as what it is that you can do. Now, the thing is, the seller pays the commission for the real estate agent, and the stuff is typically built into the price. And there may be some horse trading between the agents and things like this, and you can do a lot of things as far as the contract is concerned. This is what's typically done here. Once you've decided on the house, one of the things you want to do is what's called a home inspection. In other words, you want to walk through and verify everything is working, everything is up to par, things like this. That's one of the things you want to do when you're closing. You also want to make sure that you hire someone who can go in and give that home a good appraisal as far as what it is that it's worth and things like that. Because one of the things that's going to happen, you're going to ask for a loan for a certain amount. The loan company, the company that's going to be providing you the loan, wants to make sure that that home is worth the amount that you're trying to pay for it. Because if it's not worth that, you're not going to get the loan for the amount that you're asking for. So you want to make sure that you have it inspected, and you want to make sure that you inspect all that stuff. What is the construction like as far as both the interior and the exterior? How do things look? Is everything in good shape? Things like that. And then what happens is the price of the home is determined. One of the things that they do is what's called comps. In other words, comparable prices. What are the comparable homes that are kind of like that in that neighborhood? What are they going for? And what happens is you'll get houses that are kind of the same, going for about the same amount. And so the price of the homes kind of depends on what's actually around it, things like that. Now, there are times when the prices of homes are increasing quite quickly, and that's based on demand for some of the houses. I mean, that happened several years ago as far as the housing market is concerned. For a while, it was kind of depressed. Then all of a sudden, it's taken off again as the economy has improved. One of the things that you'll do is put a contract in or put in an offer for a home, a purchase agreement. What typically happens when you get a purchase agreement is the home is being listed for a certain amount. What you do is you put in another offer, a counter offer. All right. And it's typically lower than what they're asking for. And what happens is you do some bargaining, you do some negotiating and things like that. When you're putting in an offer, you typically include earnest money. What that's basically saying is, okay, I promise that I want to buy the house at this amount. And it might be $100, $200, $500 or something as far as the earnest money. If the homeowner accepts it and you back out, you are giving up that earnest money. If the homeowner accepts your offer and you don't qualify for the loan, you get your earnest money back. So in other words, if the loan if the things don't go through because of your decisions, you give it up. If it's outside of your decisions, you get it back. You could also have some contingency clauses as far as, okay, well, I'll purchase this home as soon as I sell mine, or something along those lines, or I'll purchase this home once this is fixed. So you can have some contingencies in there as far as how things are actually done. Then what you do is you get your payments, get your financing down. Now with the financing, you have to think about how much do you have for a down payment. If you have less than 20%, you have to pay what's called PMI, private mortgage insurance. What that is an insurance policy that's guaranteeing that the loan will be paid off if you default. The insurance company does that for whoever owns the mortgage. Once you have above 22% in equity, in other words, the amount that you have actually invested and what the house is worth is greater than 22%, you don't have to pay the mortgage, the PMI anymore. Now, you typically get a mortgage for anywhere from 10 to 30 years. Most first homeowners get a 30-year mortgage because what that does is that keeps the initial payments down a little bit lower than what you might have for like a 10 or 15 year. There are basically several phases. Okay, you put in your application and meet with the lender. They're going to do a credit report and verify everything, and they typically lock in the rate. And you can work that out with the lender anywhere from 60 to 90 days. In case mortgage rates change, it locks in that rate. So if mortgage rates are going up, you don't have to pay the higher rate. In order to qualify, you have to have, what they will do is check your income and debts and your credit history. Better have a good credit score, folks. Better have a good credit score because they're checking that. My son recently went through buying a house, and because he had some financial troubles earlier, his credit score was just a little under 620, and he was having some very difficult times getting a mortgage. Finally was able to work it out, get it above 620, was able to get his mortgage. You have to think about your down payment. How much can you put down as far as that mortgage is concerned? Sometimes mortgage companies will ask for more than what other companies might ask. Something to think about is you can get a lower interest rate if you're paying points. Points are 1% of the loan amount. It's basically prepaid interest. So for example, let's say that the interest rate is going right now for about 4.5%. They might have an offer for maybe 4% instead of 4.5%, but you have to pay 2% or pay 2 points. So let's say you're getting a $100,000 loan. You pay 2 points or $2,000 up front, you get a 4% interest rate on your loan versus 4.5%. So it's basically prepaid interest. In the book, it has the way that you can go about qualifying for a loan. One of the things I suggest you do is walk through that a couple of times with your current salary, with future salaries, things like that. There's different types of mortgages you can get. You can get fixed rate, you can get variable rate, you can get government guaranteed. So fixed rates, what happens is you get a 30-year mortgage at 4.5%. It's going to stay 4.5%. It's going to be that same mortgage payment every single month for 30 years. You can get some government guaranteed loans. So for example, the FHA will guarantee a particular loan. And you can typically get into an FHA loan for anywhere from 5 to 10% down. With a VA loan, if you're a veteran and you can get a VA loan, you don't have to have any money down and you can get into that house. This talks about some of the payment factors. Again, you can go through and kind of figure some of these things out as far as what it would cost you for a particular mortgage amount at a particular interest rate for a particular number of years. One of the things to think about then is you also have to pay taxes and insurance. Most mortgage companies are going to ask you to pay not only the principal and interest on the loan, what they will also ask you to do is pay monthly taxes and insurance. Because if you don't pay the property taxes, the county can come in and take your home. If you don't have insurance, the mortgage company is going to get real nervous because if there's a fire there, they lose everything. With the insurance, what it does is it protects you and the mortgage company. So you can go through and calculate what it is that you can get as far as a loan is concerned based on your monthly gross and how much you owe and some other things. Mortgages you can get, we talked about fixed rate. You can also get what's called adjustable rates or ARMs. In other words, what happens is the interest rate is much lower at the very beginning and it increases over time. An interest-only mortgage, is typically used in building a house. Let's say that you decided to build a house. You can get yourself an interest-only mortgage for the construction loan. So you're building the house and it's taking you about a year. You have this particular loan that will enable you to build the house and you're only having to pay the interest on it. After the house is completed, then what typically happens is you get a new loan, pay that off, get a new loan, a regular mortgage loan, where you're paying both principal and interest on that. Something else to think about is what's called a second mortgage. In other words, let's say that you have $50,000 in equity in your home. You can typically borrow up to 80% of the equity in your home. So let's say that you have $50,000 in equity and 80%, looking at the total amount, might be $30,000. So you can take another mortgage out to pay off some other bills, do some improvements on the house for up to another $30,000. Reverse mortgages. Reverse mortgages are typically where what's happening is, let's say that you have $100,000 in equity in your home. A reverse mortgage is the mortgage company starts to pay you. And what's happening is you've gotten a loan for a certain amount for $100,000, but you start off with zero. And they might pay you every month some of the money from that mortgage, from that equity. And what happens is the amount of that loan keeps going up. Eventually, what happens is you need to sell the house in order to pay off that reverse mortgage. You might see commercials for it where they're saying, this is great for seniors and things like that. It can be. The thing is, I've seen situations where people took out a reverse mortgage and they lived past the amount of equity that they had in the house. They had to sell the house, get rid of the mortgage, and they moved in with their kids. When you're buying the house and you're closing, you want to make sure that you do a walkthrough. And what I tell folks is take a lamp with you and go through and check each and every outlet and make sure that each and every outlet works. Make sure that all of the appliances work. Make sure that you can open and close the windows, that the furnace and the air conditioner works. Make sure that everything works. Because if it doesn't, and then you sign on the bottom line as far as that mortgage is concerned, you close the deal, you're stuck. Now, when you close, you better have your checkbook ready to go, because what's going to happen is you're going to have a lot of settlement costs that go along with it. What typically happens when you are getting the mortgage and you're working with a real estate agent, they will have an estimate as far as what the settlement costs will be. And it's going to be things like title insurance, appraiser's fees, property inspection, transfer of taxes, all kinds of stuff that go into it that have to be settled between the seller and the buyer. And some of the things that you as a buyer will have to pay for. Things like title insurance. In other words, you have to have an insurance policy that basically says that the title for that house is free and clear. I can buy that and I will own it. There isn't what's called a mechanic's lien on it. You have a deed, clear deed, an escrow account. You set up the escrow account. Remember we said that when you're making your payments, you're going to be paying a portion of your monthly payment in taxes and interest. The mortgage company will set up an escrow account that saves that in there, that portion of the monthly payment that you have, and then they make the insurance payment and the tax payment, property tax payment, when it comes due. So you don't have to worry about it. You're paying them every month. They're putting in that interest into that escrow account, and then they actually pay the bills on those. Well, if you're going to sell it, you need to make sure that you make it looking jam up, jelly tight. You want it everything repaired and repainted wherever you can, clean stuff up, remove any kind of excess furniture so that people can see what the place actually looks like. Bake bread. Having a nice scent. The smell of baking bread is absolutely phenomenal. Studies have shown that houses sell better when you're baking bread and people can smell that in there. You've determined the selling price. You can sell by owner. Okay, you see houses being sold by owner. What you're doing, the person who's selling it is saving the fees that they would pay to a real estate agent. Thing is, they're not getting the coverage that might be necessary. It's not being marketed as much. So those are some of the key things when it comes to housing, as far as purchasing a house and also renting things. If you have questions, give me a call.